Hello everyone and welcome back to Control Cash, your no-nonsense guide to personal finance. Everyone wants high income and growth, but usually you can't have both. That's where covered call ETFs like the Nasdaq-100 High Income ETF, ticker QQQI, come in. It promises double-digit yields and exposure to some of the biggest tech names. But does it really deliver, or is it just another yield trap? In today's episode of Control Cash, we're going to be breaking it down for you. If you find this info helpful, be sure to like and subscribe for more. Covered call ETFs have been exploding in popularity in recent years, and QQQI is one of the newest additions. It launched in 2024 and focuses specifically on the Nasdaq-100. That's the big tech names we all know, like Apple, Microsoft, and Nvidia. So how does it work? These funds sell options contracts in order to generate monthly income, which they pay out to shareholders in the form of a dividend. Explaining covered calls in detail could be its own video, but here's the quick version. When QQQI sells a call option, it gives someone else the right, but not the obligation, to buy Nasdaq-100 shares at a set price in the future. In exchange, QQQI collects a premium up front. There are two outcomes here. If the index stays below that strike price, nothing happens. QQQI keeps both the shares and the premium. If the index surges past that strike price, QQQI still keeps the premium, but the shares get called away. That means the fund misses out on some of the upside. This is the trade-off. By giving up some share price growth potential, QQQI can generate consistent income, and that's how it manages those large monthly payouts investors love to see. Speaking of payouts, QQQI is boasting a massive 14% dividend yield. To put that into perspective, a $10,000 investment would be earning you about $1,400 per year, or just over $100 every single month in dividends. That's the kind of consistent cash flow income investors love. On top of that, the fund has a unique tax benefit. QQQI uses what's called Section 1256 contracts. Without getting too deep into the tax code, this basically means the index options it trades are taxed in a blended way, 60% at long-term rates and 40% at short-term rates. For most investors, that can translate into serious savings when April rolls around. And here's another plus. QQQI actually owns the assets it's writing options against. That makes it less risky than some funds using synthetic covered calls, or what's called a poor man's covered call, where you're using options contracts to mimic the stock ownership instead of actually holding the shares. Now let's talk about the downsides, because a 14% dividend yield doesn't come for free. First, the big one, capped upside. Since QQQI is constantly selling call options, it limits how much you can make if the Nasdaq-100 shoots higher. If tech stocks go on a huge run, regular QQQ holders might see explosive gains, but QQQI investors will only collect their option premium and miss out on most of that upside. Second, payouts aren't guaranteed. Distributions can swing from month to month depending on market conditions. When markets are volatile, option premiums are higher, and the fund can generate more income. But when markets are calm, premiums shrink, and that means your monthly dividend could come in much lower. If you're someone depending on this income to pay bills, that lack of consistency can be a real drawback. Third, limited track record. QQQI was only launched in 2024, which means we don't yet know how it will behave during prolonged bear markets or extended periods of low volatility. Until we see how the fund manages through tougher conditions, there's some uncertainty around its long-term reliability. Now that we've gone over some pros and cons, let's take a look at how QQQI has actually performed since its launch. From the stock chart, the fund's share price is up about 9% since inception. That might not sound huge, but remember, this is while also paying out a double-digit yield every single month. Looking closer, there was a massive dip in February of this year after President Trump announced significant tariffs on US trading partners. At its lowest point, QQQI was down nearly 20% from its highs. But here's the remarkable part. It's already made a full recovery. That's not something you typically see with covered call funds, which usually lag behind when it comes to share price appreciation. At least for now, the monthly payouts don't seem to be cutting into the NAV, likely thanks to strong earnings out of the tech sector over the past few years. Now, let's talk about distributions. This year, the highest payout came in May at about 64 cents per share, while the lowest was in April at around 53 cents per share, right in the middle of that tariff-driven sell-off. To put that into perspective, if you held 1,000 shares of QQQI, you would have received about $637 in May, but only $530 in April. That's a meaningful difference if you're depending on this income to cover bills. Looking at the bigger picture, since inception, the fund has averaged around 61 cents per share per month, which is actually pretty stable compared to other covered call funds in the market. And when we calculate total return with dividends reinvested, the numbers get even better. A $10,000 investment at inception would have grown to about $13,633 today. That's a 36% return, or roughly 21% annualized, which is also right in line with what the S&P 500 returned over the same period. The key difference, of course, is that QQQI is an income-driven fund. So what are the key takeaways here? Well, in my opinion, after nearly 2 years of running its strategy, the fund has delivered solid results. We're not just talking dividend income. The share price itself has pushed back into positive territory, which is rare for covered call funds. Even more impressive, it has managed to keep pace with the S&P 500 over the same time period. Yes, the monthly dividend has some variability, but in normal market conditions, it's been stable enough that I'm not overly concerned. Combine that with a massive 14% yield, and to me, this stock looks worth the risk. That's why this month, I've decided to put my money where my mouth is and invest $5,000 into QQQI myself to test the waters. So what do you think? Is QQQI a smart way to earn income while still riding the Nasdaq wave? Or do you see too many risks under the surface? Drop your thoughts in the comments below. And if you found value in this breakdown, make sure to leave a like, hit subscribe, and turn on notifications so you don't miss out on future deep dives into dividend ETFs and income strategies. This is Control Cash, helping you take control of your money. Keep investing, keep stacking dividends, and I will see you in the next one.